9,000 Bitcoin ATM machines went dark today, all at once. The largest Bitcoin ATM network in North America just shut down and filed for bankruptcy this morning. And here's the part that should stop you cold. At the exact same moment that 9,000 physical machines that let ordinary people walk in off the street and buy Bitcoin with cash were going offline, Wall Street's Bitcoin ETFs crossed $104 billion in total assets. 104 billion. Two completely opposite things happening on the same Monday morning in May 2026. And then underneath both of those stories, there is a third one. A sanctioned nation state just launched a Bitcoin-powered insurance platform around the Strait of Hormuz, one of the most critical oil shipping choke points on the entire planet. Today's episode is about all three. And by the end of it, you are going to understand exactly what this moment means for the future of Bitcoin access in America. The Bitcoin Report is on. I am AI Ryan Matta. Real Ryan put this script together earlier this morning, went through the source material himself, and handed it off to me to deliver while he deals with the rest of his day. That is how this channel works. Full transparency always. Today is Monday, May 18th, 2026, and we have one of the more genuinely interesting news days of the year so far. Three stories that on the surface look separate, but are actually telling you the same thing about where Bitcoin is heading and who gets to access it. If you hold Bitcoin or you are trying to figure out whether you should, stay with me for this one. Let us start with Bitcoin Depot because that is the story that broke this morning and it is the one you are going to see on financial news all day. Bitcoin Depot filed for Chapter 11 bankruptcy in the U.S. Bankruptcy Court for the Southern District of Texas this morning, May 18th, 2026. The company announced it would wind down operations and sell its assets in a court-supervised process. And when they say wind down, they mean it. This is not a restructuring. This is not a pivot. The company is shutting down completely. Every single Bitcoin ATM machine in their network has already been taken offline. 9,000 machines across 48 U.S. states, Canada, Australia, and Hong Kong. All dark. As of this morning, Bitcoin Depot was not some small startup. This was the largest Bitcoin ATM operator in North America. They were publicly listed on NASDAQ under the ticker BTM. They controlled roughly 28% of the entire U.S. crypto ATM market. When you drove past a gas station or a convenience store and saw a Bitcoin ATM machine in the corner, there was almost a 1 in 3 chance it was a Bitcoin Depot machine. That is the scale of what just went offline. So what actually killed them? The company's CEO pointed directly at the regulatory environment. Increasingly stringent state-level regulations and enforcement made the business model unsustainable. That is the official explanation. But the numbers behind that explanation are brutal. In their most recent quarter, preliminary revenue fell 49.2%. Nearly half their revenue gone in a single quarter. They posted a $9.5 million net loss. By April, their own SEC filing warned investors that 2026 core revenue was expected to fall 30 to 40% versus prior years just from fraud mitigation and regulatory compliance costs alone. The stock went from $1.29 at the start of 2026 to essentially pennies by the time they filed today. And in April, on top of everything else, they suffered a security breach that resulted in the theft of $3.7 million from the company. The regulatory angle is worth spending time on because it is the real driver here. Crypto ATM fraud hit a record $389 million in reported losses last year. That is a 58% increase from 2024. A large portion of that fraud involves scammers calling elderly people, convincing them their bank account is compromised or that they owe the IRS money, and then directing them to a Bitcoin ATM to deposit cash as a way to supposedly protect their funds. It is a devastating scam. It has been running for years, and Bitcoin Depot was directly in the crosshairs of it. The attorneys general of Massachusetts and Iowa filed a high-profile lawsuit against the company over allegations that it facilitated crypto scams. That lawsuit, combined with the compliance costs of fighting it and rebuilding their fraud prevention systems, pushed the company to the breaking point. Here is what this means for you as a Bitcoin holder. The on-ramp that let ordinary people walk into a gas station with cash and walk out with Bitcoin, no bank account required, no brokerage account required, no identity verification beyond what the machine itself collected, that on-ramp just got dramatically smaller overnight. 28% of the US crypto ATM market is offline right now. The people most affected by this are not sophisticated investors. They are the people who do not have easy access to apps, brokerage accounts, or digital banking. People who operate in cash, people in rural areas, older Americans who are just learning how to use these machines. For them, the path to Bitcoin just got harder. Now here's where the contrast hits you like a truck. The same week that Bitcoin Depot's 9,000 machines go dark, US spot Bitcoin ETFs crossed $104 billion in total assets. $104 billion. BlackRock's IBIT alone is almost 2,000 times the size of Bitcoin Depot's entire market cap as of last Friday. Think about what that number means. The institutional door into Bitcoin has never been wider. If you have a brokerage account, if you have a 401k, if your financial advisor can access ETFs, you have cleaner and cheaper access to Bitcoin than ever before in history. But the cash door, the door that does not require a bank account or a brokerage relationship or a smartphone app, that door is closing. The gap between how institutions access Bitcoin and how ordinary unbanked people access Bitcoin just got significantly wider this morning. This is the tension that the Bitcoin community has to sit with right now. Bitcoin was created partly as a system where anyone could participate without needing permission from a bank or a government. That vision is not dying. But the infrastructure that served the most cash-dependent segment of the population is getting hammered by regulation. And the regulation is not entirely unjust. The $389 million in fraud losses last year was real. Those were real people who got hurt. But the response, which is effectively making compliance so expensive and litigation so threatening that the largest operator in the country shuts down entirely, that response has consequences for Bitcoin access that go well beyond the fraud problem. There is another layer here that the bankruptcy story does not fully capture. The crypto ATM industry as a whole was already shrinking before Bitcoin Depot's collapse. Regulators in multiple states have pushed through new laws requiring more aggressive identity verification, transaction limits, and consumer disclosures. Some states have capped the fees that ATM operators can charge. Bitcoin Depot's fee structure was one of the highest in the industry, sometimes charging 15 to 20% above spot price for a transaction. That fee model worked when there was no competition and no regulatory pressure. It stopped working when both arrived simultaneously. The bankruptcy this morning is partly a story about a specific company's model breaking, but it is also a leading indicator of what is coming for the rest of the crypto ATM industry in the United States. Now let us pivot to the other major Bitcoin story breaking today because it runs in almost perfectly the opposite direction, and it is genuinely one of the more remarkable things to happen in Bitcoin's history. Iran's Ministry of Economy officially launched something called Hormuz Safe on May 16th. It is a Bitcoin-settled maritime insurance platform built specifically for cargo ships transiting the Persian Gulf and the Strait of Hormuz. The platform issues digital insurance policies for vessels moving through the region. The policies become active once a Bitcoin payment receives blockchain confirmation, and a cryptographically signed digital receipt is issued to the cargo owner as proof of coverage. Iran is projecting more than $10 billion in annual revenue from this platform. Let me give you the geographic context first because it matters enormously. The Strait of Hormuz is the single most critical shipping choke point in global energy trade. About 20% of the world's oil supply passes through it every day. Saudi Arabia, Iraq, Kuwait, the UAE, and Qatar all depend on it for the bulk of their energy exports. There is no alternative route. If you are a tanker leaving the Persian Gulf loaded with oil, you go through the Strait of Hormuz or you do not go at all. Iran sits on one side of that strait. It has enormous practical leverage over everything that moves through it. Earlier this year, starting in mid-March 2026, Iran's Islamic Revolutionary Guard Corps began charging transit tolls to ships passing through. The toll structure starts at around $1 per barrel of oil on board. A fully loaded, very large crude carrier typically carries around 2 million barrels of oil. So at $1 per barrel, one tanker pays $2 million to pass through. The IRGC has been accepting payment in Bitcoin, Chinese yuan routed outside the SWIFT banking system, and in some cases USDT. Estimates from blockchain analytics firms suggest the toll system could be generating up to $20 million per day from oil tankers alone, with $600 to $800 million per month possible if liquid natural gas vessels are included. Hormuz Safe takes that toll system and dresses it in the language of insurance. Instead of paying an explicit toll, which sounds like extortion and which would trigger immediate sanctions analysis, cargo owners are buying an insurance policy. The insurance policy happens to be issued by an Iranian state-backed entity. The premium happens to be paid in Bitcoin, and the coverage happens to be for the very waters that Iran controls. But on paper, it is insurance, not a toll. The reason Bitcoin specifically matters for this scheme is straightforward. Iran has been under comprehensive US and international sanctions for decades. The SWIFT banking network, which handles most international financial transactions, is effectively closed to Iranian entities. Dollar-denominated transactions can be frozen instantly by US authorities. In January 2026, US regulators froze $344 million in USDT tied to Iran. That action probably accelerated Iran's interest in Bitcoin specifically because Bitcoin is harder to freeze and harder to trace than dollar-backed stablecoins sitting on centralized blockchain networks. When you send Bitcoin peer-to-peer directly to a wallet address, there is no intermediary to freeze the transaction. That is not a bug in Bitcoin's design. It is the feature that makes it useful as a neutral settlement layer. Now, here's the compliance reality that has to be stated clearly. Any shipping company that uses Hormuz Safe is taking on significant legal risk. Payments to Iranian state-linked entities, regardless of what currency they are in, can trigger sanctions violations under the U.S. Office of Foreign Assets Control, commonly called OFAC. A ship arriving at Rotterdam or Singapore carrying a Hormuz safe insurance certificate is probably going to find that certificate worth nothing to local regulators and port authorities. The global maritime insurance market does not recognize Iranian state-backed coverage, and any company that routes Bitcoin payments through a platform connected to the IRGC is potentially exposing itself to severe enforcement action in the United States and Europe. So Hormuz Safe faces real obstacles to becoming a functioning global insurance market. The operational status of the platform itself is still unverified. The website listed in early reports was not fully functional at the time of writing. Full policy terms, underwriters, exclusions, and claims procedures were not publicly available. The $10 billion revenue projection from the Iranian ministry has no breakdown or methodology attached to it. But here's the thing about Hormuz Safe that matters, regardless of whether the platform ever becomes fully operational. The fact that a nation state is building Bitcoin-powered financial infrastructure around one of the world's most important trade routes is itself a historic signal. Iran is not using Bitcoin to speculate. Iran is not buying Bitcoin to hold it as a treasury asset. Iran is using Bitcoin as an active operational settlement layer for sovereign commerce. That is a fundamentally different category of Bitcoin adoption than anything the market has seen before at state level. And it is happening at the same time that a Trump warning about Iran pushed Bitcoin below $76,500 this morning as oil spiked to $112 per barrel on Brent crude. Let me connect those two price data points. Bitcoin dropped to $76,500 today on Trump's Iran warning. Brent crude topped $112 per barrel. And Iran is simultaneously building Bitcoin payment infrastructure tied to the very oil that is driving the crude price spike. Bitcoin is simultaneously a risk-off sell when geopolitical tension rises and a neutral payment tool being adopted by the geopolitical actor causing the tension. The market is not ready to price those two things simultaneously. It sells Bitcoin on the Iran headline while Iran is literally building Bitcoin infrastructure underneath it. Now bring back the Bitcoin Depot story and hold it next to the Iran story. In the United States, the regulatory apparatus just made Bitcoin ATMs so expensive to operate that the largest operator in the country shut down completely. In Iran, the government is actively building Bitcoin-powered financial infrastructure at a sovereign level. American regulators are making it harder for an unbanked American to buy $50 of Bitcoin at a gas station. Iranian policymakers are engineering a system to collect potentially $800 million a month in Bitcoin from global shipping companies. These two stories running on the same day in May 2026 tell you something important about Bitcoin's trajectory that no single price chart can show you. The technology is neutral. Bitcoin does not care who is using it or why. It does not care if it is a retired teacher in Ohio trying to convert her Social Security check into hard money or the Islamic Revolutionary Guard Corps collecting transit fees from oil tankers. The network processes transactions. That neutrality is Bitcoin's most powerful property and its most politically complicated one. Because when hostile state actors use Bitcoin for sanctions evasion at scale, it gives every politician who wants to restrict Bitcoin access in America a real and legitimate argument. The fraud narrative that killed Bitcoin Depot and the sanctions evasion narrative from Hormuz Safe are going to show up in the same congressional hearing about Bitcoin regulation. Count on it. For the Bitcoin holder watching this, here's the practical takeaway. The short-term price pressure is real. Bitcoin at 76,500 is dangerously close to the monthly close level that Fundstrat's Tom Lee identified as the bull market confirmation threshold. He said earlier this month that if Bitcoin closes May above $76,000, the bear market is definitively over. Bitcoin has never in its history closed 3 consecutive months up while in a bear market. May closes in roughly 2 weeks. We are sitting approximately $500 above the line right now, with oil spiking, Iran tensions escalating, and a macro backdrop that remains hostile to risk assets. Every day between now and May 31st matters for that monthly close. The medium-term structural picture is more complex. Institutional access to Bitcoin through ETFs is growing at a pace that was unimaginable 3 years ago. $104 billion in spot Bitcoin ETF assets is not a speculative number. That is real capital that has been allocated to Bitcoin by real institutions. The retail cash on-ramp is shrinking through regulation. The institutional on-ramp is expanding through Wall Street infrastructure. The Bitcoin that flows into a BlackRock ETF and the Bitcoin that would have flowed through a Bitcoin Depot ATM are the same Bitcoin. The supply is the same 21 million coins, but the type of holder is shifting rapidly from cash-paying retail customers at gas stations to institutional allocators at investment banks. That shift matters for price dynamics over the next cycle. Institutional holders generally have longer time horizons, larger position sizes, and less panic selling behavior than retail holders who bought Bitcoin at a gas station on an impulse. That is a stabilizing force for Bitcoin over time, but it is also a concentration of ownership and access that changes what Bitcoin is in practice, even if it does not change what Bitcoin is by design. The long-term story has not changed. 21 million coins, hard cap, no exceptions. Inflation running at 6% at the producer level in the United States. A new Fed chair who has signaled no rate cuts this year and possibly hikes. Sovereign entities from Bhutan to Iran either selling or actively using Bitcoin in their economic operations. Corporate treasuries holding nearly 4% of all Bitcoin that will ever exist. The ETF complex absorbing supply at a rate that makes the post-halving supply reduction look small. All of those forces point in the same direction over a multi-year time frame. The day-to-day price being pushed around by Trump tweets about Iran is noise. The structural accumulation of Bitcoin by institutions, while retail access gets harder, is the signal. Bitcoin Depot's bankruptcy is a chapter in the story of Bitcoin becoming money for institutions before it becomes money for everyone. The Hormuz safe story is a chapter in the story of Bitcoin becoming useful infrastructure for geopolitical actors who have no other option. Neither of those chapters is the final one, but both of them together on the same Monday morning give you a clearer picture of where we actually are in this cycle than any price chart can. Subscribe to this channel right now if this kind of breakdown is useful to you. We publish every day. The whole point is to cut through the noise and give you the actual story with the actual numbers so you can make sense of what is happening to your Bitcoin stack in real time. Hit subscribe. It takes 1 second and it is free. Before you go, head to bitcoinmaxing.com. Real Ryan built a free Bitcoin retirement calculator there. You put in your current stack, your accumulation plan, different price scenarios, and it runs the math on what your Bitcoin position could look like at retirement. No cost, no sign up required. Link is in the description below. I am AI Ryan Matta. See you tomorrow.